Good morning, everybody.
Good morning, sir.
So, probably today be the last class for us, and I hope for some time I will be. I may not be taking sessions in future due to my pre-engagements, and even this session I was not able to really fully concentrate and do that for the simple reason that I have taken up a new responsibility with my employer. So quite preoccupied, so responsibilities. So it was a little difficult task for me. So, but then I didn't want to sort of halfway stop something which we started, so that because it will be detrimental to you, like to work with two resource people. So anyway, now we have come to the end of the session. Few of the things what I was telling you all right from the beginning is that which keep in mind that you all are doing a postgraduate course. This particular postgraduate course will contribute for some students, will contribute for you to get your promotions. Maybe sometimes for some students it may be kind of a prerequisite for a promotion from your current levels, and a few other students may be doing this for the enhancement of their knowledge and enrich their CVs. So whatever may be the case, what I was telling from the beginning is that a course when we are doing of this nature and at this stage in your career and in life, you need to try to derive maximum benefit from that. So that I wanted it to be, because the discussions what we have is more important than the exam results. The kind of knowledge what you gain from interactions gives more room for you to kind of mature as a bank employee and show your competencies to your employer. So that's very important. This is what I say, that rather than the destination, as far as this is concerned, rather than the destination, the journey is important. And in the journey, how do you participate is important. So that this is what I had been insisting at the beginning also. At the end of the session also, I'm telling you that you could have done better, right? I told you that in a postgraduate session, it is not about somebody delivering a lecture and somebody listening and then doing an exam or whatever. It is about the interactions and then sharing of knowledge, and then which really we all are coming from various banks, various backgrounds, many financial institutions. So your interaction here will enrich each one of you. So knowledge sharing, experience sharing, and then down the line, whatever, someone can make a mistake, someone can say the right thing, and then kind of bring in a lot of market intelligence, bring in the differences between the cultures and all that. So that's what I was expecting, that in a session like this anyway. So but then what happens is that I find in the students, the mentality most of the time I see that is that they want to do the minimum and get through the exam, and then getting through the exam and getting a pass is more important than any of these things for them. So which perception if you have, I hope that you must change that, right? You are not alone. We also thought like that. We also, when you go and do an exam, think that better, somehow we must get through the exam. But then as you sit and think, from the exam, from the certificate that we have passed, what we gain, And what we gain from active involvement in the journey, in the sessions, which one contributes more? When you go back and by hindsight look at it, it is the second which contributes, because tomorrow qualification is something which can take you, like, or show that you are you are eligible for a particular thing. You are eligible for a promotion, you are eligible to be in a new position, you are eligible to take up a new responsibility or whatever. But then once you take up the responsibility, once you have that new this one, what happens is that your ability to sort of manage the situation, show your maturity, show your knowledge, show your skills is what will carry you through. So there are many people who have gone to a certain extent in their career, and then from that, at that career, at that point, the people above start to think that either he is unable to perform at that particular level, or like this is something which is beyond his current ability and competency level, so that he has reached the career plateau. From here he can't progress anymore. Or like sometimes we also feel that some people whom we have promoted, we used to think that okay, whether the promotion was not properly evaluated, because someone is unable to perform at this level, so why did we promote him, right? He is not showing the competency levels of ability to shoulder the new responsibility for which we have promoted him. So a lot of people show that also, like they show that that's because we haven't concentrated on the journey. What I say, the journey, what we, if you have concentrated, you would have prepared yourself for that kind of a situation. Like either when you're meeting your superiors and then convincing them with your ideas to go for a lending proposition, to recommend the customer, or else presenting your case and then winning there, or doing a presentation in front of your superiors, whether it is your corporate management or your senior management, or to whom you are doing a presentation and then convincing them in a crowd, in a forum when you are meeting, how you are conducting yourself and then showing your maturity, your knowledge, your skills and all that also is important. That's how people carry. They will identify. Your CEO will see, that fellow seems to be knowledgeable fellow, very well behaved, and he sort of seemed to be having a good market knowledge. From what he speaks, I think that he has good theoretical knowledge, good market knowledge, and think that he has skills. So why don't we look at him? Why don't we look at him? That's how people come up in their career. So now what happens is that when we are taking an approach of being kind of a backbencher and passive participation, and the same thing we will carry to our workplace. Same thing, like okay, let him do, right? If he knows, let him tell, kind of a thing. So when a question is asked in a forum, if he knows, let him say, why should I bother? That kind of attitude we will carry to the environment also. End of the day, what happens is that we don't get highlighted. We don't get the opportunities what we want. So we think that just because we have the qualification, we should be recognized, we should be given promotion, we should be that and this, and then there are many people who complain, I have this one, I have that one, I have so much of years of experience, but then why the management is not recognizing us? Is really bad. They are promoting youngsters, young people who have less experience, all that kind of lot of complaints, lot of grievances which come. I have come across many people who say. But what the problem is that the ones who are complaining like that, they themselves put a barrier to their progress. They don't come forward. They don't put their hand up and come and try to take up a new responsibility. They don't volunteer, and they do the minimum. And when it comes to personal or job board, they give more importance to their personal things and kind of that attitude. What happens is that's what push them behind. But then later they will blame the management. They say, no, the management is not looking after us. So how much we have contributed to this organization and all that kind of things. But if we really look at do a self-analysis and see, maybe we haven't done our bit to earn that, right? From the corporate management, we see this day in and day out. While interviewing people, while assessing people to higher responsibilities, while targeting somebody for some specific task or responsibility or whatever, every day we come across this kind of things. And then, so that is what I'm contributing to you. I'm telling you also that, okay, in this session, maybe that everybody's contribution was not forthcoming. That maybe in a face-to-face classroom session, of course, I pull a lot of people, pull them along because I get them to speak, I get them to present, I get them to come and place their arguments in front of kind of things, because that's just to improve their leadership. So assignments are given for them to think and come back and all that kind of thing. So unfortunately, on an online thing, our that kind of things are a bit restricted, and it's only an expectation that you all are listening to me, right? It's only an expectation, and then I only get the feedback like what you speak back, how do you answer and all that. From that only I get the feedback. Otherwise, yeah, it all fully depends on you. To take the maximum out of it. So that so please take the responsibilities. Now, many of you would have been married and having children. You must, what is the kind of guidance you give to your children also is important. How seriously they take up their, educational endeavors. All the time, you all are guiding them. So set an example. So that's what I wanted to tell you. Keep on improving. So this is very important, right? Okay. So last week I was telling you so last week I was telling about IFRS or SLFRS 9 financial instrument, and then the purpose of this session is not to go and do an in-depth study on this, but a few things I told you must keep in mind. What does SLFRS 9 has done to us, right? What is the change which has taken place, and what do you so what do you mean by impairment, right? And how do you do the impairment calculation? How do you do impairment provisions? How do you do? And whether it is in addition to what the central bank has told and all that also we discussed in the the last class. So just to run through this for me, I will tell you, this is the central bank's guidelines which issued in 2018, right? By end of 2018, they issued this circular. On that also, they gave some guidance on SLFRS 9, because SLFRS provisions, impairment provisions are done according to Institute of Chartered Accountants guidelines, right? And then on that so that they were giving some guidelines to the banks by central bank, so that banks are in uniform in applying that, right? So in that some important things here we will run through. So like what I told you, our purpose is not to go and do in-depth study. That of course has to be done separately, right? Okay. So now we last time we looked at how do you financial instruments for banks, how do you classify that? How do you how do you identify the financial instruments? So starting from we are giving loans, we have in our assets, we are invested in debentures, we are invested in treasury bills and bonds and all that kind of things. How do you these are all financial instruments. How do you treat them, right? For accounting purposes is something which we were looking at last time, right? So again, I will show you the Chartered Institutes one also. This is what basically this is what had to be understood. Held to collect, if that is the business model, think of a loan. So you hold the asset to collect the contractual cash flows. That is your principal and interest, right? So so that is so the cash flows are consisting of the capital and interest. Meet SPPI test. That's what SPPI test is. What solely for solely for the purpose of principal and interest. So SPPI. So on a loan, if you keep in mind, this is what is happens. Now we are not going to do mark to market valuation and all that on a loan. Loan is there that periodically, monthly or quarterly, or the customer will be paying the capital and interest, or interest moratorium. If you are given something after a period of time, they will pay the capital interest, right? Okay, whatever way, that is the cash flows. I mean that's the SPPI test basically. Infrequent and insignificant sales. We don't do the sales on the loans what we have. So that is held to collect. So that of course the treating, it will be treated like a amortized cost, right? It's amortized cost. Keep on reducing. Then the other one what we looked at is if any instrument you are keeping to collect and then for sale, say for treasury bills and bonds, if you are keeping that, we will collect the interest coupon rates periodically. Once in 6 months, coupon rates will come. We will collect the interest, but depending on the market conditions, we will sell also, right? So this kind of instruments, of course, will have to be treated through the fair value through other comprehensive income. That's what we famously we say, FET, OCI, fair value through other comprehensive income. So here what happens is you collect the contractual cash flows as interest will be paid, or at maturity some other things, matured deposits will come, but we keep selling, buy and keep it, and then we say keep selling. More frequent and significant sales, right? Significant sales, market conditions. So that is the second treatment. The third one is that other business models, trading purposes, right? Managing assets on a fair value basis, maximizing cash flows through sale. So now, what happens is that shares. Let us say we are buying shares. Your financial institution that buy shares. So you have a portfolio, you buy and sell. So you do trading, right? So when you are doing that, the value of the shares will go up and down. So managing the assets on a fair value basis. So based on the fair value, you manage it. You maximize the cash flow through the sale. Like when the prices goes up, you sort of trade on that, right? So it's not neither held to collect. Yeah, I mean in these kind of cases, you don't keep it held to collect, dividends will come, I'm keeping it to collect, and or else the second case, like the held to collect and for sale, it's not that, but then we do trading, right? So collection of contractual cash flows is incidental. Now in the dividends are coming, that is incidental, but the main focus is that we keep trading, right? So much of buying and selling and all that. So that of course will have to be handled through the fair value through profit or loss, right? Fair value through profit or loss. So because when you do that, what happens is your asset value keep on going up and down. So that kind of, if you don't recognize in the profit and loss account immediately, your assets will show a wrong picture because you are trading on that. The second case what we looked at is that in that case, of course, they are, you do that. You collect the contractual cash flow. You wait till you hold it to collect, but infrequently you do the significant this one, you do the sales also. That is of course now, like, the other belief is that the profit and loss account effect compared to the last one what is so is a little less. So you keep it under the other comprehensive income, which basically other comprehensive income is shown below the profitability calculation, after tax profitability calculation, and after that this adjustment is done. Right. So then so equities and instruments, these are held for trading. So that's what I told you, fair value through profit or loss account. And equity investments not for trading and not elected the irrevocable other comprehensive income means that also fair value, that means through profit and loss account you do. Not for trading and elected to irrevocable, say the same thing. Fair value through other comprehensive. When you say that you are not going to trade, right, and then elected this OCI option means it will be under OCI, you will other comprehensive income. Derivative instruments, of course, that will keep on going up and down. We in Sri Lanka less amount of derivative instruments. That, of course, fair value through profit and loss account, because derivatives, there will be fluctuations, lot of fluctuations in the market price also for derivatives, actively traded. So due to that, fair value through profit and loss account. These are the few things what you need to understand when it comes to this, so that I have given you the central bank's guideline also here. How do you do the classification? Same way, I can show you how the Chartered Institute treats this. I have given the guideline of Chartered Institute also. So here also, if you see, if you see, in a banking environment, classification of the financial assets are, what is the type of the financial asset holding, right? You forget about LKS 32. What is the type of the financial asset holding, whether it is a debt instrument, whether it is a derivative, or whether it is an equity instrument. Now our loans and all that, if you keep in mind, that's a kind of a debt instrument. Let's say debt. So cash flow solely from payments of outstanding principal interest. Yes, our loans are like this. So that's the SPPI test, where the cash flows are solely from payments of outstanding principal interest amounts. There is no other way. If the customer doesn't pay, means we have no way. We are not doing that much of active securitization. Parcel this up and then sell it to somebody to collect or whatever. No. So the cash flows are solely from payments of outstanding principal and interest amount. So SPPI test, that is. So it is yes, assess the business model. What is the business model? Whether we hold to collect. No, loans, of course, we hold to collect, right? When you hold the loans to collect, fair value option applied? No, we don't apply the fair value option. That means what? It is amortized cost, right? No, means it is amortized cost. So in case you have a debt instrument, okay, we keep it for SPPI test, that qualifies, and we keep for both. We hold to collect and sell when it comes to, like, typically on a let us say treasury bills we have, We hold to collect and then sell. So we are invested in treasury bills and we hold to collect and sell. Let us say we invested when the interest rates are 9%. Now the interest rates are 6-7%. We sell it. We get a good interest margin compared to the current market prices, right? So hold to collect and sell, fair value option applied. In this case, we will be applying fair value, right? If you are applying fair value on the treasury bill, because the fair value of that is high, right? Compared to the current market conditions, the fair value of that is high, above the investment amount, right? Because of the interest differential, right? So in that case, fair value through other comprehensive income. It is to be accounted through that. Then if you hold to sell, like, I mean, in that case is the last one we looked at, hold to sell. I mean, your thing is that, I mean, you know, it's selling. Selling means fair value through profit and loss account, right? Fair value through profit and loss account. So that's a debt instrument, okay? So you look at the derivatives are there, like derivative instruments, of course. Derivative can be like, I mean, any of the instrument which is the underlying thing will be happening or not happening something. So in Sri Lanka, derivatives are not that much developed. In the Western world, there are a whole lot of derivatives developed. That means that's an instrument. It's a financial instrument that has a price which has an underlying. Now you need to pay a premium, and then you can utilize on the derivative. You will get the income based on something happening or something not happening. Now, like whether index will go up, means you paid it, you will be paid. If the index doesn't go up, let us say share index, it doesn't go up. You asking for you actually paid the premium that expecting that the index will go up. Index doesn't go up. The index has gone down on a particular date for which it has been booked. Then you lose your premium. It's like that, right? So those are derivatives. Now in our market doesn't have that much of derivatives, except for interbank. Some derivatives are there. Then the equity instruments, if you take, so derivative instrument, of course, basically do that, and then that is only market value, right? So fair value through profit and loss account. It's a market based, fully market based. If it can go up, I mean, based on the current market conditions. So those fair value will have to be assessed from the market, and then profit and loss account will be adjusted. When you come to equity investment, of course, you can do trading, right? If you're trading, yes means it's a fair value through profit and loss account. If you don't do trading, right? If you don't do trading, you keep it, then fair value through other comprehensive income, right? Other comprehensive income. So here you will choose for whether it is fair value through other comprehensive income or not. If it is not, it is the fair value through profit and loss account. This is the basically you need to keep in mind. In addition to this, what happens is that what you should keep in mind, the other one is that there are three, now when it comes to a loan will have to be, you will have to do impairment provision, right? There's impairment provision on a loan in 3 stages. There are 3 stages on which you do the impairment provisions. So I just basically will say the 3 stages you will. These are the 3 stages, impairment model at a glance. So there are 3 stages, right? So on a performing loan also, there's a stage 1 impairment, recognition is needed. That is, the credit risk has not increased significantly since the initial recognition is what stage 1, and stage 2, and stage 3. So stage right. So initial recognition, subsequent recognition and all will be on the expected credit loss. Stage 1, it will be there. There has to be a model used, right? Model acceptable to the central bank you will be using. Then stage 2 is that underperforming, a credit risk has increased, where you identify, and lifetime expected credit loss. The LECL means lifetime expected credit loss for purchased or originated credit impaired financial assets. This is where, like, stage 2, you do the impairment provisions, and then stage 3 is that non-performing, right? Credit impaired, which is credit impaired. The other high amount has to be impaired. So recognition of the interest, effective interest. So effective interest, you effective interest on the gross carrying amount, effective interest on the net carrying amount is what under these 3 stages you will look at. I mean, these are basic things what you need to understand. You don't need to further how your bank is recognizing and doing this and all that. You can have a chat with your accounts department. They will tell you. For you, from my end, what you need to understand is that impairment provision is based on the future, right? So in 3 stages you will do the impairment provisions on loans. So those 3 stages are like performing, underperforming, and unperforming, like that. So when you're doing these impairment provisions, there is there are independently, individually significant amount you will take, and then that will be separately loan by loan provision to be made, and for the group below a particular amount decided as per the model, for that the total there will be impairment provision will be done. So in two ways the financial institutions do the impairment provisions under IFRS 9. So like what I told you, under IFRS 9, when you are doing this provision, now the one other thing is that when a provision under this formula, like a provision is made, and then if a loan is categorized to the next level, credit risk has increased significantly, in the next is credit impaired. When it goes to those stages, of course, under that lifetime expected credit loss on that impairment provisions will be done. When that situation improves, also under certain conditions, you can take it back to the previous stage, right? You can take it back to the previous stage. That also can be done. That also the guidelines are available under what circumstances those are done. Where the customer's situation has improved, he is regularly paying, his cash flows are okay under those conditions. So the intention of our session is that basically to give an idea to you on this, which I have done, and these are model based. Every bank, every financial institution will have to be having a model in, so that has to be endorsed by the auditors, and then that should be accepted by the central bank. Also, based on that only, they will do the impairment provisions. There may be slight changes between banks in their model. So the broader guideline is given here. So you please go through this, and it's for your knowledge. You can have the relevant documents from the Chartered Institute, the relevant document from the central bank, all I have provided here. Right? Any questions from you on this? Yes, students, any questions?
So it means now when different banks are recognizing this impairment, they are using their own model. No, there is no any uniform guided model by the central bank. No?
Yeah, no, they are using their own models anyway, but it has to be kind of you know uh, it has to be ratified by the auditors. Auditors' endorsement should be there. It should be acceptable to the central bank also. So that part has to be there. Then, but then the models used by the banks do differ. The amount, individual impairment, individually significant loans, what they take, and all that. I mean, loan size and all that, that differs. That the central bank is receptive to, they haven't implemented anything very kind of a uniform model or whatever. No, is for the, because these impairment calculations are model based. So that's why I didn't want to go deep into that and then say, because it may be partial. I mean, because different institutions have different ways of doing this. So it has to mature now, because this now only it has come. It has to mature. When it matures only, kind of some uniformity will come. So that's why I didn't want to go beyond that. Now, while you are transferring a loan from one stage to the other, or transferring back, also this rebuttable presumption, there is one, regardless of the way in which an entity assesses a significant increase in credit risk, because the credit risk, how significant increases also is subjective, right? There's a rebuttable presumption that the credit risk on a financial asset has increased significantly since initial recognition when contractual payments are due after more than 30 days. Normally, this after more than 30 days, the is not paid means it will go into the 30-day thing. I mean, second stage 2. So then the financial asset is considered to be in stage 2, and lifetime expected credit losses would be recognized, subject to reasonable and supportable information to demonstrate that the credit risk has not increased significantly since initial recognition. Even though the contractual payments are more than 30 days past due, this presumption can be rebutted. For example, let us say now more than 30 days it is overdue, you need to put it to stage 2, but then you don't put it to stage 2. You say that under this COVID-19 situation, under moratorium, so we are not transferring that. That's okay. That's a rebuttable presumption, right? So that the central bank is okay with that, because central bank also has given the approval for that. I mean, that's a rebuttable presumption that even though it is overdue for more than 30 days, we are not putting it to stage 2. So 30 days past due simplification to measure the significant increase in credit risk permits the use of delinquency together with other more forward-looking information to identify a significant increase in the credit risk. The 30 days past due rebuttable presumption serves as a backstop even when forward-looking information is used, right? So that is one thing. I mean, the banks will use. A good example, what I told you, was under COVID-19 situation, where central bank also has given moratorium, principal, and then interest moratorium has been given. So under that, even though more than 30 days overdue, we are not going to put it to stage 2 and stage 3 because okay, that kind of a presumption, right? Right. So I think only that much I will tell you about these things. For your information, for your knowledge, please go through this whole 17 page documents which gives knowledge to you. You are not going to basically in depth. I'm not going to test you on this. I will not, for exam purposes, I'm not going to test you. On the surface, I will ask you some questions, whether whether these whatever I told has gone into your mind. I may ask some questions, but in depth, I'm not going to go and check on the kind of what is the model, how do you calculate and all that. I'm not going to ask you, because these are model based things, right? So the expected credit loss, calculation, I give the Chartered Institute's guideline here. You can say delinquency-based approach. right? So the components of expected credit loss calculation, what are the components they take is probability of default, exposure at default, loss given default. Those amounts are taken for the calculation, right? So, and rating, of course, internal rating based approach currently being used. Qualitative factors taking into consideration the credit risk characteristics at initial recognition subject to continuous review. So these are the factors for the recognition of a loss allowance. Components of loss allowance are these, right? And then basis of impairment, like what I told you, individual impairment is loan-based, individual loan-based impairment. Collective impairment is for a group. Now, like, okay, all the loans below 100,000, 100 million, you take and do a collective things, something like that, collective impairment. So based on that, the impairment provisions varies, right? So far as that is acceptable to the auditors in central bank, fine. All right. Any more questions? So please go through these, what I have given, these documents, what I have given, please go through this. It's a kind of a comprehensive knowledge for you, so that when someone is asking about these, you will not act as if for example, I mean, when I was interviewing somebody who is in the recoveries department, I was asking about this, they could not explain. People think that, I mean, this is not part of their job. So when someone is in the recoveries department, they should know. So they seem to know only the central bank provisions, what we have studied. That is based on the past record. That provision we'll have to make, but impairment provision also is important. The changes what is taking place, right? That comes under IFRS 9. So I have given you sufficient material for you, explained what is relevant to you, but you should know in that. So please go through this and please have a fair knowledge on that. I'm not going to ask you what percentage you use and how do you calculate and then what is the amount you provide. All that is not necessary, but you must have the knowledge. And you will go into that if you are working in the finance and accounts, finance department. If you are working, you will know, right? So what kind of how your institution is getting about this, you please talk to your finance people how they are doing this, and then try to have some knowledge. Any questions?
So is this impairment charges is a novel concept introduced by this SL 19, or was it in place prior to that?
One sec, I'm not getting your voice right. Wait. Yeah, can you please repeat it?
Is this impairment charges concept is a novel concept introduced by this SL 9, or was it in place prior to that too?
Your voice is breaking. I don't really understand. Now, sorry, please repeat it again. Your voice is breaking to me.
Is this a novel concept, the impairment charges, which is introduced by this IFRS 9, or was it in place prior to introduction of the IFRS 2?
IFRS 9 is a replacement of IAS 39, IAS 38. Right? Previous standard used was IAS 38. I mean, how do you recognize the financial assets is something which the previous one, this comes as a replacement of that. Accounting, basically for the published accounts, this comes as a replacement for that. You know that, I mean, earlier also we had this IAS 39, sorry, IAS 39. In that, I mean, we had this issue of mark to market valuation, held to maturity, held for sale, how do you treat, and all that was there. So there we were not touching the loan things, loans were like, I mean, amortized cost, it was going on. But other investments, of course, we were doing these, mark-to-market calculation. But that has been replaced here. IAS came to being for the simple reason that instruments which we are carrying in the balance sheet, off balance sheet items, there are a lot of off balance sheet items also, which end of the day, what happens is that, I mean, that creates a significant amount of risk to the banks. For example, the financial meltdown, the previous standards could not do much. After that only they introduced this particular IAS 9, this kind of impairment provisions, recognizing these losses, looking at the market movements well in advance and on a continuous basis, so that the financial institutes don't face with a huge shock. What, like, there are many financial, I mean, hedge funds and banks and everything had to be closed down during 2008. So much, a huge amount of losses were made. So this comes as a cushion for that, basically. Okay.
Okay, sir.
Right. All right. So, as students, we have come to the end of our session. So, I am going to touch on another paper. So, we'll just discuss this and then have a interactive session. Right. Okay. So this is a paper. Question number 1 asks about, will the profitability of banks be affected by the implementation of IFRS 9? So you all tell me, will the profitability will be affected and how? Yes, go ahead.
After introduction of the IFRS guideline, in addition to central bank provision, we'll have to calculate this impairment provisions too. Then it will be had to charge against the profit. Then the bank profit will be getting reduced.
Yes, bank profit will definitely be reduced, because in addition to your central bank required provisions on the past record, you are providing impairment provisions also based on the cash flows of the customer. If there is delinquency in his paying current this one, and then if there is a kind of from the time you have assessed and given the loan, if the cash flow position goes down, your predicted cash flows goes down, then you have to make impairment provision. So when you're doing the impairment provision, definitely that's from the profit. So from the profitability will be affected, right? That's simple, right? Okay. The rest of it, of course, we'll just discuss and go, because the kind of ratios you must calculate, like the guidelines what I gave you. So customarily, we will give a financials, and we'll ask you to do the calculations, ratios, profitability, liquidity, leverage, and performance or activity. On that, you will have to do the calculations. So basically here, what we are having here is that some book company, their balance sheet sales, cost of goods sold, and then gross profit, other operating expenses, general administration expenses, depreciation, operating expenses, operating income. This information is given until net income. You have the thing, right, which is given for 3 years, and then the balance sheet has been given, right, and you are asked to prepare for under every heading at least 2 ratios you are supposed to prepare. So you, like what I told you, you tabulate and put it for 3 years better, so that you can compare, number one. Number two, at minimum 2 ratios you should have calculated. That's number two. Number three is that under every heading, now, like, I mean, this is A, B, C, D, means everyone will, every section will have a 4-mark thing. So for two or more under one heading, under profitability, if you are calculated, you can put you a small brief also. What is what do you think about that ratios, whether ratio is improving? So net profit ratio is improving, gross profit ratio is improving, operating profit ratio is improving, or, like, I mean, big increase, reduction, or whatever. On that, what you take, you may give a small 1-2 line your message on that, to say that, I mean, what is the what do you understand from that. In the liquidity, of course, you will look at the liquidity, of course, will say about how liquid is the company in meeting the short-term commitments and all that. That's why you will look at, normally look at the current working capital ratios, like current asset minus current liabilities. You look at and then working capital. So current ratio, quick ratio will without including the inventory, you will calculate, right? So, and then the other liquidity ratios, what you can think of, you can make use of it, and then do a liquidity calculation. Leverage basically talks about how much gear. So you can use the gearing ratios, how much borrowed funds and how much equity. The ratios, gearing ratios, you can use it, and then so that's about the leverage. And then performance of activity means normally we look at the how is the performance, how much the during the year, how much the stocks have been turned over, what is the stock turnover period, right? What is the creditors turnover period, what is the debtors turnover period, what is the asset turnover period, right? Assets, how much turned over during the year. That shows that, I mean, how the performance, how much the those particular things, whether assets or whether creditors or whether debtors or whether so those things, how it is turned over, right? I mean, over a period of time, 3 times, 4 times during the year, right? So credit period, like 60 days or 90 days credit period given. That means, I mean, 3 months credit period given to the customers. Like that, I mean, you look at the performance. And then you look at the over a period of time, 3 years, how it is improving. And you will give you a small introduction, your take on that. So once you have done your, tabulated your ratios, then you go to the next question. You will look at, in view of the fact that the company has requested for a term loan of 100 million repayable in 5 years period to import printing machinery to their factory, analyze the position of the company using the above ratios. So you will look at, and then how liquid they are, how the liquidity is, how the profitability is. That when you look at how leverage, whether it is okay, whether can they be more leveraged, right? They are getting more loans. So whether leverage is acceptable. Leverage is now, like, I mean, leverage ratio, when you look at, I mean, asset to borrowing to total assets. When you have that lesson one or something like, I mean, you find it that's acceptable. More than one means it's a little above. So on the leverage on the banking side also, we were talking at the beginning of that. Banks are exceptions. We are multiple times we are leveraged, but the companies in the market you can't expect it. Now that's why you are asking, even for a project you are asking 25% contribution. Why you are asking for 25% contribution? Okay, we will give you one part, you will have to put three, we will give you three, one for one third, I mean 3/4 we will give you, 1/4 you will have to put. So at least 25% you must put. That's what we say. So you look at the leverage and then see whether that is acceptable, and then whether 100 million additional can go. Still it is okay, you look at it. Otherwise you will have to comment, and then look at the other performance activity, and all that also will be helpful for you to come to a thing like, I mean, it's a well-performing business, and then we are like, I mean, profitability is acceptably, profitability is growing, and the liquidity is good enough, and leverage is sustainable, so that additional loan can be taken, so repayment is not a problem. Like, I mean, how do you come to your calculation? Logically you will write. So that's about your this ratios, and then writing about your take on the particular proposition of giving additional loan. Then the next one is easy. So whether it can be accepted. From these things, you will your assessment from there, you will say whether it can be accepted. And in addition to that, you will have to ask other information also, which other informations are basically you will have to look at what is the project is doing, what is your project cash flow, give the cash flow, project cash flow, right? Not only the balance sheet and all that, I need to look at the cash flow for you. Whether you will have sufficient cash flow to meet these commitments. So look at the project cash flow, project report, right? And market study. So for the particular product, what is the market, right? The market intelligence. Then of course, if the property is going to be taken as a security mortgage, in that case you will have to ask about the type, documents related to the property, title report, valuation, and all that you will need, right? So based on that only you will prepare your proposal. So those are things you will ask for. The moment you mention about that, you get full marks, right? So this is actually the 40-mark question. What you have at the beginning of the question paper is actually is easy. But don't ever think that, I mean, you can, without answering this, you can pass the exam, because it will be a bigger, huge test, and then more chances of going down than getting through the paper. So that's about this ratio analysis. Last time also we looked at these, additionally DSCR calculations also. Debt service coverage ratio, where you will look at your earning before interest, taxes, dividends, and accruals and all that. So those that you will take that figure, and then you will divide it by the commitments, customers commitments, current year commitments, and then see whether they can cover the debts from the particular profitability. EBITDA we call it, earning before interest, taxes, dividends, and accruals, right? Now the DSCR calculation also, what happens is that more than one means, okay, that's comfortable. Customer is able to, from that, I mean, you can meet the loan commitments, right? So normally businesses will have multiples of that, right? Multiples of that, right? Okay, so that also is an indication. Okay, Now, the next questions. A crucial factor in deciding the quality of a loan portfolio is non-performing advances. Explain the reasons for NPA formation. What are the warning signals for an NPA? Right? So a question of this, you will break it into many parts, and then you will identify what you have to write. So a crucial factor in deciding the quality of a loan portfolio, which we have told, your institution, your financial institution will be assessed based on the NPA portfolio. That's one of the crucial factors, right? How much is the NPA? If somebody says my NPA is 10%, then it's a weak institute. It's a weak financial institute. That's how the market will look at it. Because 10% of your total loans is not performing. So that is not a good thing. But under the current situation, many of us will be forced into this. But that's the scenario, right? Explain the reasons. So what are the reasons for NPA formation? So reasons for why NPA get formed, and what are the warning signals? So this question has two parts. So you may have to break it into two and write. It's a 10-mark question. So you can't write a lot, right? So that you can break this into two parts. The reasons for NPA formation, these are the reasons for which there is NPA formation, right? So what kind of warning signals you get? Slightly connected, right? It's connected, but how you write earns you higher marks, right? So first you must think that, you have NPA portfolio, for what reason it has been formed. So you are going to write the reasons for that. You have an NPA portfolio already. How it got formed, you are going to write. Second one, your knowledge on looking at loan, looking at a borrower, and then identifying at what stage he is, whether he is okay, he is well performing, no problem, or whether you are getting any signals from him, from the market, right, from the external factors, from the internal factors of the company, whether you are getting any signals for this particular facility is going to be in NPA, right? So warning signals, that's part number 2. So this 10-mark question, 5-mark, you must you will write. So NPA formation, what are the reasons for NPA formation? So go on, tell what we have studied. NPA formation, what are the reasons? Yes, go ahead. Don't wait here, because this is your bread and butter, and it's just offhand it should come. Right? What are the reasons for NPA formation?
Improper structuring.
Yeah, okay. Improper structuring, right? Okay, that we looked at. If somebody is structuring up a facility in place of term loan, if you are giving a OD, improper, right? Hardcore formation will be there. If you give more than what is required, there will be a misuse, right? If you unnecessarily give a particular limit, that may be misused, and then customer can fall into trouble, right? So say somebody doesn't do import-export business, but then you give a LC limit to him. So he will tend to bring something which he actually is not very well aware of, not experienced in, right? So improper structuring is one, right? What else? Keep talking. Bear in mind, you are talking to me, and there is the last session, right?
Not reviewing the facility on time.
Yes, not reviewing the facility on time. We are waiting for the accounts of the customer. We are waiting the time he will give the accounts. Or due to our inefficiency, we keep on postponing, and so that we don't know what's really happening in the company. And by the time we go and review, say 2-3 years it is delayed or whatever for review, by the time we go and review substantial deterioration in their performance, right? So it's I mean imminent sign of that getting into NPA, right? Now we are talking about reasons for NPA formation, because we haven't reviewed on time, because we delayed, we were uh, we were inefficient in that. Due to that, NPA formed. Okay, 2 good reasons. What else?
Not monitoring the utilization of funds.
Yes, misuse of funds. Many times this happens. Many times, irrespective of whichever bank, it may be state bank, it may be private bank, it doesn't matter. Everywhere this happens. Everywhere this happens. Sometimes we do the name lending. The other day, I was looking at a particular customer who was pleading with me that to give him some cash flows, give him some working capital for him to run the business, because everything got stuck, because this has become non-performing advance, these all loans, and he is unable to run the business, and then we are not helping. And I looked at the history to see that he is a politician. He is a politician. He had things, like many things. I mean, he was having a luxury life. He was having factories, garment factories, and so many other businesses. And we have given working capital facilities. It was going on, like, going on. But what happens is that this guy has siphoned off the money, taken the money from those businesses and used it in his politics. So used it in his politics, and then now he's stuck. Now the people around him who ran the businesses also, they also played out a bit, because this man is fully into politics and then never not concentrating in the business enough. So all these businesses, without proper supervision, that has fallen into trouble. Excuse is that this man has taken money out of those businesses into politics. That's our weakness. Our weakness of not really following this up and then putting him on the right track when this happens. Sometimes these are also sensitive, and politicians, when you are lending, so difficult to correct them. However much you say, they will not. They will say, we know that, we know how to run the business, we know how to run the country, they will say. So, but then that is the reality. Now this man is pleading, and then I also feel sorry for him, but I can't even give a single cent to him, because all his facilities, all the working capital facilities, everything given, term loans and everything given, has become NPA, right? So no proper monitoring and follow up. The third very valid reason what you gave. Anything else?
Customer unable to face the market challenges.
Customer unable to face the market challenges. Time and again, this happens. Let us say somebody, one of your customer, is in the printing business. He's in the printing business very traditionally. He prints, and then he has some customers, and he does that. Now, let us say another printing business, a competitor comes and puts a latest machine, and which has at a low cost, he gives many features, high features, and then cost is low, and they are capturing the market. Now this man is unable to cope up with the competition, right? He goes down, unable to cope up with the competition. The last time you will know that, I mean, many corporates, many large number of corporates, large number of banks, and all, we never printed diaries also. The market would have lost a lot of business, right? People in that line would have lost a lot of business. So we thought, this additional cost, and then no point. Under COVID-19, we need to contain cost and all that. We never, printed the diaries. Calendar diary printing is minimal last year compared to all previous years. So that the people who are depending on these will be into trouble if they don't look at alternative this one. There are companies, let us say, security printing. Security printing, there are a few companies in the market. They do the security printing, checkbook printing, right? And all that. Those are very high security area. What happens is that the usage of checks are coming down, right, in the market. Usage of now RTGS has come, and then slips and the other way of fund transfer is happening. So between interbank fund transfer is easy, like never before. Easily you can transfer account to account. Fund transfer is easy through internet banking. You can do the transfers. So that the traditional printing of checks and issuing and all that going down. Even the companies are looking at dividend payment and all going to be kind of online account transfers. So huge amount of check usage will come down. Only the people in the business who are giving post-dated checks and then getting getting goods and post-dated check up, or like leasing companies who are getting the post-dated check from the borrowers, and then lessees, and then deposit those checks. So for that kind of, except for those things, the usage of checks comes down. So that those businesses they will have to reinvent themselves. Otherwise, they'll be in trouble, right? That's going to be a problem for them. They won't be able to sustain in the business. If, say, for example, they haven't looked at other areas, they are only solely depending on these, and then they have borrowed from banks, huge amount of capital machinery invested. They are going to face the trouble. So when you are lending to a customer like that, and then when you are assessing the customer, you must have an eye to look into these things, right? You must have an eye to look into these things. That's very important. Time to time, this keeps on changing. The examples I told you, everywhere we had studios, color labs, and everything was there. So everywhere the film roll was sold, and then we were taking film roll, putting film roll and filming, and then developing the film roll. That was a big business around the country, every nook and corner. You see that, how it has changed. People are totally out of business, right? Those cameras, that business totally gone out of this one. Now digital cameras, right? Now mobile phones, even camera business has gone down. Mostly mobile phones, like only professional photographers have these cameras with them. Others all keep these mobile phone and manage. Right. The other day, we wanted to take a passport size. So like yeah, correct. Some photograph, makeshift. In this road itself, there are some near RMV. There are people who are taking photographs. Guys are using mobile phone. They take mobile from the mobile phone. They take a photograph and then they print and give. They don't have, even in the studio, they are using a mobile phone and taking and processing and giving. So the market keeps on changing, right? So unless we also look at these things and then look at the customer, assess the customer, it will be a difficult task, right? So those reasons. So now you will have to keep on telling about these. What are the reasons for NPA formation? So this comes from your experience, right? If you ask your recovery department, they will come out with various things like this. Anything else? Anybody want to tell? Reason for NPA formation?
Proper succession plan is not in place.
Yeah, proper succession planning. So this is happening in many businesses. Father, there are so many businesses which is doing well also. I used to look at these particular St. Anthony's group companies. See this Mr. Jnanam, he's the father who actually started the business from scratch. It was told that he used to collect scrap material from home to home. He carries on his head and then collects scrap material. That's where he started. It was told in his childhood days. But he became an entrepreneur. Worked hard and worked hard to come up in life, and then he started many businesses, and their sons have taken over. Sons and grandsons have taken over. They are running the businesses, and they are very big. Tokyo Cement and all that. These Orient City is theirs, and then and St. Anthony's Industries, these. Probably to the Anton PVC company. I mean, so many IT park, so much of businesses. There is succession. There is sons and grandsons and all that. I mean, they are running the businesses. There are many businesses where what happens is that father painstakingly puts the business. The other day I was talking to another business, a very famous business, very known household name in the market. The father has built up that. So the 3 children, 2 daughters and 1 son. Son also not interested in the business. He just enjoys his lives and waits. And daughter also not interested in business. And another daughter, I found that she was a commercial pilot. She is a commercial pilot. She left her job and come and join the company. That to see that, I mean, the father's business is not let down. It has to be run, and because that's very well-known company. I don't want to tell the name. Well-known company. So I actually appreciated the daughter. That, I mean, thanked her because such is the reputation the father has built. But the succession is not properly planned, and when the father passed away, the people who were managing the business also very inefficiently managed or played out or whatever. The business has drastically gone down. So the succession, no proper succession plan. That's how you do a assessment in your paper. Succession, what is the succession planning, whether it is in place, you'll see. In the same way, only I was telling you some time back also, many businesses, once it is developed, they try to put the professionals, qualified people in the management. Why? Because qualified people have some professional ethics, and then they look at the business in a professional way and run. So there are many people who you put the professionals, they will be dormant. The owners will be waiting and then on the sidelines, giving the management to the professionals. The professionals will be paid a good salary, where they will say, and then they will run. The owners will be kind of honorary job they will have, so like chairman or whatever they will can say, but not really get involved with the day-to-day business. So that is one part. I say that also is a good enough succession plan, right? Good enough succession plan. In many US companies and all that, you can see that that's what they do, right? That's what they do. You can see Google, how Google is now, the CEO is Google company is an Indian gentleman, right? Sundar Pichai is the CEO. He's running. He's a professional, right? Who has come through the ranks in the company, and then he's the CEO. The owners have taken a role, side role. They don't get actively involved. Likewise, even Amazon also is appointing somebody. You can say the Bill Gates. What did he do? Bill Gates also, I mean, he quit the company. He quit the company. He's in the sense, he's a director, owner, and all that. he has shareholding and everything, but then he gave it to market professionals, right? They are running, right? So Microsoft is run by Satya Nadella. He also is from India, professional, right? So like that, many companies, whether you take Pepsi Cola, Coca-Cola, companies, these company, big corporates and all that, everyone, they are the owners take a back seat and give it to, because for the sake of proper succession, in the sense proper running of the business, right? Professionals. Now, like, I mean, if it is qualified accountant, somebody, qualified accountant, they have their own ethical code of ethics. No, they will have to, accounting ethics, they will have to follow. So they are under oath for to the professional institute. If it is Chartered Institute of Management Accountants, SEMA, or ACCA, they have to comply with the ethical standards. If they don't comply with the ethical standards, if there's a complaint coming, if it's proven, maybe their membership also will be cancelled. That they will not stake, because that's reputation, that's their brand. So due to that, professionals running the organization is one way. Otherwise, the offspring, the children or grandchildren, they will have to be, very competently, they will have to take it and run. Now, I see a lot of companies we are here. This second generation messes up. They mess it up because they are educated, overseas educated. They come, they think that, I mean, the business is there. They will run, they will start new ventures, that and this can be done, that can be done. All, you can't do everything. You studied the bookish things also. You have to very carefully go. So some people succeed, some people make a big failure, and the father's hard-earned wealth goes down. That also happens. So succession is very important, right? Anything else? Right. So enough we have spoken on the NPA formation. Tell me about the warning signals. What are the warning signals? I mean, the same thing on the futuristic thing, like current thing, when you give also, it is the same thing, like, I mean, in a way, right? So, if you identify there is no proper succession, if you identify the, structuring is wrong, if you identify that, what we spoke about, purpose for which it is applied, which is not properly done also. So other warning signals, you tell me, from the, from their conduct, you will get lot of warning signals. Give me some warning signals.
Current account performance.
Yeah, current account performance. Current account performance. Yeah. If the performance goes down, if the turnover goes down, if the debits are more than the credits, right? If there are, like, the credit turnover, debit turnover, what you had looked at the time of assessment, previous assessment, if it is not there, which is going down, there are round sum figures are coming to the account. That means whether they are borrowing from outside and then paying it off, right? And then in the performance, what are the other things? Like check returns, right? You have check returns. But there are frequent check returns. There are frequent stop payments, right? Stop payments, check returns. What else?
Hardcore formation.
Hardcore formation. So what we discussed some time back, after some time you find that there is hardcore. The customer is only above the limit operating or slightly lower than the limit and above the limit operating, all the time asking for TOD, right? So something wrong. Fund has been diverted or lost, whatever, right? What else?
Key people are leaving from the company.
Key people are leaving from the company, right? So this quite often happens. Somewhere recently I saw that a company called PC House, which was PC House. They are the computer accessories vendor. and then they, in a big way, they incorporated a company, they borrowed from all the banks, a lot of borrowing, and then they hired people from the market, all these who and who in the market, all big names, they were in the board and all that. After some time, company performance going down, they are finding it difficult. Slowly, these directors were resigning from the board and going. All these names which came in slowly going, right? They started going. Then imminently, the company became bankrupt, and then banks had to, run behind, file. There are cases filed. There are the properties are being auctioned, and all that is happening. So that's a sign. Like, key people, whether it is the directors or whether it is the employees, it may be for a good reason, but then it may be for the reason that the company, there is problem also. So that also you need to follow up. Anything else?
Payment for creditors are stagnating.
Yeah, creditors stagnating, right? They are like, creditors are not being paid, like, banks or from wherever they are creditors. Trade creditors also stagnating, not being paid. That means no sufficient cash flows to pay, right? So that's the reason, right? Okay. What you discussed earlier regarding the products also, whatever product they are dealing with, if that product is sort of becoming out of fashion in the market, the demand for the product is going down also, is a warning signal, right? What we discussed. Anything else? Right. So you have enough of areas to comment on this kind of, if you get a question like this, it's a bonus for you, right? So this is what you are dealing with day in and day out. Then we go to the next question. Parate execution, right? We looked at Parate execution. Parate execution, right, is considered to be a boon for commercial banks in their recovery of non-performing loans. Explain the difference between recovery through civil case and Parate execution. It's a 5-mark question basically, to try to understand whether you know what is a Parate execution and then what is the difference between the civil case and the Parate execution, right? So what you can say, you let us say about what is Parate execution, under what circumstances you can exercise Parate execution, and how does it differ from, say, a civil case, right? How does it differ from civil case? That's all needed. It's a 5-mark question. You can't be writing a lot, right? So tell me, what is a Parate execution, right? And tell me what
minimum amount for Parate execution is 4 million.
Right.
But that civil case is 150,000.
Correct. So under what circumstances you can apply Parate execution? What are the prerequisites to exercise Parate? One is this limit. The other things?
The property mortgage is not be a third-party mortgage.
Yeah, you must have a property mortgage, that too.
Be in the borrower's name.
Yeah, in the borrower's name.
Primary mortgage is required.
Yeah, primary mortgage, right? Person holding the primary mortgage, and can go for Parate execution. Like what I told you, let us say there are 2-3 mortgages on a particular property. The primary mortgage, secondary, tertiary mortgages have been entered. Let us say the loan given for the primary mortgage is settled, and the primary mortgage is cancelled, right? Because the loan given for the particular thing is the particular primary mortgage is not a common security. It is given for a particular loan settled, primary mortgage cancelled. Now, even though you have secondary, tertiary mortgage, those will be considered primary and secondary, because the moment primary mortgage is cancelled, the next mortgage will become primary, right? For the law, purpose of law, the secondary will become primary thereafter, the moment the primary is cancelled. So that keep in mind. And parate execution basically is a right given to the banks under statute, under Banking Act, the 1990, I hope, it is given, the right given, and but it is confined to these, it has to be the third party you can mortgage, it has to be the borrower. Exception may be in company accounts, a director owners their properties mortgage can be, the latest case laws show that that also can be auctioned, like, because that is the director owners of the company, their property they are mortgaging, right? So some latest cases show that that can be, right? So that's the exception. Other than that, that's third party mortgages. You cannot go for parate execution. You will have to go for a money suit or civil case, right? So civil case, when you go, it's a long drawn affair. So civil cases will take time. So if you ask a difference between these things, the other thing is that, parate for what you will exercise, others you will go for civil case, and parate relatively efficient. You don't go to courts. You just get the board approval, give all the documents, and then recall the loan, and then get the board approval, and then appoint the auctioneer. Auctioneer will auction the property. So that's relatively straightforward process and fast. But if it is legal case, it will take time. You will have to, do all the clearance from the board, and then you will have to go file a civil case, money suit you will have to file. So it is and then the case will keep on getting postponed, and then it will go on. So it's a long drawn affair, civil case, right? So civil case, of course, like you mentioned that above 120,000 you can go for a civil case. We also looked at the mediation board, the things and all that. They are in the mediation board, the loans which are not settled also, they will give a certificate of non-settlement, and then with that you can go for a civil case, right? So that's the difference. So it's a small question. What are the advantages of using mediation board for a loan recovery? This is what I was mentioning also, mediation board. So tell me, what are the advantages of using mediation board?
Loan can be recovered without go to court.
Yeah, loan can be recovered without going to court. Now, especially small value loans, this is very useful, because this is in your community, this is happening. So like, people, judges who are appointed by the finance ministry, who are there, like, the members of the mediation board, and people are called, and then you try to amicably solve it. It's a kind of a gentlemanly arrangement. So people who are decent enough will try and sort it out there, and then finish it out, rather than going for a long drawn case and all that, right? So but this is an effective method anyway, that that helps without cost is much less, right? With very less cost, less effort, can sort out the cases. What else?
Bring the current into the case as a party.
Yeah, you bring the borrower as a party, or guarantor also, if he is there, you bring a party, bring them as a party. Most of the time, this kind of a there will be a kind of a smooth discussion to sort out the issues. Right.
Excuse me, sir. When the current is come as a party, at the time current will be come as a indemnifier, no?
Guarantor will be called, and then he will, he is indemnifier, he will come, but Anyway, now guarantor's part will come only at the point where the borrower is failing. Borrower is unable to give a plan. Borrower is unable to give a, come to a settlement. Then only the guarantor will be called. So guarantor will be persuaded to pay. He'll be persuaded to pay. If a guarantor says I can't pay, is again an issue. You will have to go to courts, right? So it's not indemnifying. I mean to say indemnifying. The meaning is that something already given, somebody is coming to make good that. So when you are taking an indemnity, say for example, you are taking an indemnity for a guarantee. So you are giving a guarantee, credit guarantee to somebody, and then taking their indemnity. Now what happens is that the moment the guarantee is claimed, you pay, and then get it from this party. So he has to indemnify that indemnity, or create a loan in his name. So that's indemnifying. Somehow whatever loss which has already occurred, we try to recover from him. Now here, yes, in a way, indemnifier term is okay, but then if the guarantor says that I'm unable to pay, again, it will be a case on the borrower, right? It will be a case on the borrower. The guarantor also will be a party to that. Or else, in the alternative, if the borrower is totally unable to be recovered from the borrower and all that, lender can go and file a case against the guarantor also separately. Separately also case can be filed for the recovery. So, purely with the strength that he has guaranteed. Right? In a way, but the word what you're using is right, but yeah, there are ifs and buts. Right? Are you okay with the mediation board?
Yes, sir. But if is there any other advantages of using mediation board for a loan recovery?
Yeah, the advantages basically is that it's a simple process. It's a simple process for loans up to 600,000 now. Up to 600,000 can be referred, and then less costly. Ability to amicably sort it out. Those are the advantages basically. Without much publicity, you are able to sort out the issue. Right. So those are the advantages. As I said, I can think of now.
So that 500,000 is loan outstanding balance for the capital.
Outstanding. Current outstanding. Your outstanding, how much? I mean, now there is, though there is a limit of 600,000, it doesn't mean that even more than that you can go. I mean, you can go. Yes. I mean, the statute says that you can go. You can go for more than that also. Like, if it could be done, it can be done. No problem. But the normal limit is 600,000. So this is kind of a moral suasion, you see, kind of giving a moral suasion to recover the loan. Not much of a pressure on the borrower, trying to push him to come to a settlement. He can always walk away. He can say, no, I can't, I don't agree with you, and then he can always walk away. So that kind of a mild way of doing recoveries. But trying that is better because the success rate is there. There is success rate.
So mediation board limit is 600,000 or 500,000?
I think it is 600,000. It was increased to 600,000. I hope.
Only 200,000.
Previously 200,000.
Then I think 500,000.
Anyway, I will check on this and then tell you. Mediation board. Okay. Let me check on that, and I'll tell you before today somehow before the class ended. I will tell you. It was 600,000. Like anyway. So keep it as 500,000. I will tell you. There was an act amendment which came in 2016. Like let me see. Okay. 2016 amendment comes, section 7 amended. Yes, 500,000. Right. Okay. 500,000. You're right. 500,000. This act amendment came on 21st July 2016. According to that, it is increased to 500,000. Sorry. Now I made a small. Because I was thinking about this deposit insurance 600,000, that I mixed up with that. Yes, mediation board 500,000. This is effective from 2016. Yeah, right. 500,000. Correct. Anything else?
Sir, this is a little bit out of the scope right now. So, what is the term of legal interest?
What is the term of?
Legal interest.
What is that? I mean, you didn't understand the term of legal interest, is it?
Yes, sir.
Okay, legal interest, of course, in these things, of course, I mean, court basically for their calculation, they mention a rate, interest rate. On that, the outstanding and then the penalty and all are calculated. Say, from a particular date, you must pay with the legal interest, means that the rate is stipulated by them. That rate has to be, taken from them. At that rate, you will calculate the outstanding. I mean, interest. That is a legal interest rate. Okay.
Okay, thank you.
Yeah. So sometimes they mention this. I mean, you will have to pay the legal interest from such and such this one. So they have legal interest, means, I mean, we do not have a commonly declared interest rate for legal interest, but they will have, based on the from the central bank, this one and all that. I mean, they will have from the register only. You will have to find out what is the legal interest rate, and then in writing you will have to take that particular rate information and do that. So that's legal interest rate. Anything else? Okay. We'll go to the next question. Yeah. Keep on answering. What are the factors to be considered in pricing alone? And this is also a theory area. 1, 2, 3, 4, 5, 6. You can say that. What are the factors? From important things to down the line. Tell me. What are the factors to be considered in pricing alone?
Cost of fund.
Yes, very important. Cost of fund. This one thing, when you are now, like we were talking about RAROC. RAROC is risk-adjusted return on capital. That means how much of capital you will have to allocate based on the riskiness of a particular loan. Based on that, doing the pricing. But for ROC also purely you can't apply because your cost of fund also is important. I mean, for example, for a commercial bank, for a Sampati Chinbio Bank or some People's Bank, the cost of fund may be different from a finance company, right? NBFC, non-banking financial institution, NBFI, their cost of fund may be different from a bank, right? So they will be pricing now, leasing and all will be pricing based on their cost of fund. They need to keep a profit over that. But bank price, cost of fund is low, so their loan pricing will be lower. That's why the banks are in a position now with the liquidity position. Prime customers are being given at the PLR rate and all that, prime lending rate and all that is given. Which even at the prime lending rate, even the finance companies cannot borrow from the banks, right? So cost of fund. What else?
Loan tenor.
Tenor. Yeah, loan tenor. Correct. The period, because the banks, cost of fund and then liquidity gaps are there. They are like, sometimes short-term funding is costlier than the long-term funding. Sometimes long-term funding is costlier than the short-term funding. Either way it can happen, right? So the tenor also decides. Okay. What else? Collateral, yes. Collateral. How liquid is the collateral? Sometimes the cash, if it is cash back, means we give only a small percentage above the deposit rate you give. It's a property mortgage, you try to give a better rate. If it's stocks and book debts, means maybe interest has to be slightly higher. But in that too, sometimes with the customer profile, the customers are blue chip companies or big companies or big corporates won't be able to charge a higher rate. But depending on the security. If it's unsecured, we will charge high. The very reason why for credit cards and all you charge a very high rate, because it's unsecured and risk levels are quite high, right? So like personal loans, like casual loans, casual overdrafts charge high because the risk is very high. Risk of non-payment is very high. So security. Then
Customer risk profile.
cost of
Customer risk profile.
yeah, correct. Customer risk profile. Yeah, customer risk profile is important. What kind of depending on what kind of a business the customer is in, right? If the risk is high, then the return also has to be high. That's exactly what the RAROC we were talking about. Risk adjusted return on capital. If the risk is high, you try to charge high, right? The risk is less. That's why we are, for a new customer, you charge a higher rate. For a well-established customer, tried and proven customer, you charge less, right? You charge a low amount, right? What else?
Bank liquidity level.
Banks liquidity levels, yes. That's what we were talking about, the finance companies and then banks and all that. When the banks liquidity levels, if it is high, they can price low, right? If the liquidity is low, their marginal cost of fund will be high. Then they have to charge the loans also high, right? So banks liquidity, yes. What else?
Capital allocation.
Capital allocation, yes, true enough. For example, say for gold lending, when you are doing your capital allocation is 0, so you can afford to give a lower rate, because gold lending, on one side you are not doing any capital allocation for the loan given, and I mean you have a liquid asset backing it, so you can give a lower rate, right? Say SMEs and all that, compared to other commercial loans, capital allocation is low. So you for capital adequacy purposes, you may take 75%, right? For housing loans, you may take 50% if it is used for the borrower's housing purposes. So, I mean, for that you give a lower rate, right? You give a lower rate because you get the advantage from the capital allocation, right? So for a 5-mark question, you have enough, right? So you can put 1, 2, 3, 4 and then write. These are what are the factors? These are the factors. How will you ensure that an approved loan is used for the purpose requested for? What do you do? How do you ensure? How can you ensure that the loan given is used for the purpose requested for? It is something, even though it looks very simple, we fail. We actually fail in this many a times, right? We don't go that extra mile to ensure that the loan taken is used for the particular purpose. So now, what kind of measures you all take to ensure that it is going to the particular purpose?
Carrying out a
Inspection can be done.
Inspection can be done. Okay. One other student said something.
Adhere the disbursement conditions.
Yeah, disbursement conditions. You can have a disbursement condition that this should be applied for the particular purpose. You go and do an inspection now, like let us say if it is purchasing a stock, whether they have purchased the particular stock, you will go and see. And if it is taken for some construction, whether construction is happening or whether funds are applied for the construction work, you can see. And you put a disbursement condition also, this should be applied for this. But customers, the moment cash goes to them, sometimes the problem is that they don't bother about the disbursement condition. Unless we have some sort of a control over that, they will go and misuse it. Right. So what other ways?
instead of
Usual loan repayment.
I didn't get you.
instead of
Usual loan repayment.
Yeah. Two students are talking at the same time. One put the mic on and talk.
instead of disbursing funds direct to the customer's account, giving pay orders direct to the vendors.
Exactly. Many of the cases, that's what we do. Like if it is a housing loan, you give the pay order to the seller, right? Somebody for a purpose, if he is going in, buying a property for a business also, give it to the seller. If they are procuring something in bulk, give it to the seller. Pay order issued in the name of the seller. So that ensures that it goes to the particular seller. Unless in extreme situation, they connive and then get that and then give it back or whatever. Those are kind of things which we can't, have control. Other than that, of course, there's a good control where you give the pay order in the name of the particular seller. So some other circumstances are there where the customer will say, no, in a hurry, I have already purchased it and I given the money. These are the evidences for having paid the money, and I have to give the money back to from somebody I borrowed in the meantime. So give the, give the payment in my name. Still leave it as give the payment in my name. Don't give it in the seller because seller already paid. So if we have evidences to show that for the seller being settled and then he having borrowed and all that, some evidences are there, means okay, we check and see that, so that you ensure that it can happen, because bank also, when we are doing so many things and so many checking and all that, sometimes the seller will say that no, I'm going to give it to somebody else who is waiting, you are taking long time. So sometimes these guys will borrow from their known sources and then sell it and settle, and then they say, the moment loan is passed, I will give you. That also can happen. So ensuring that the seller gets the payment. Yes. Anything else?
Keep in touch with the borrower even if the repayment is prompt.
Yeah, exactly. That is a credit officer's art of credit officer. Continuously with your customers, being in touch with him. You be in touch with him, what he is up to, right? So that's a hard task anyway. So like what you say, if the loan is being paid on time, many of us will think, why should I be in touch with the customer? He's paying the loan on time, no problem, right? Why should I do that? So the sacrifice of being in touch with him at frequent intervals is that you avoid any risk of seeing all of a sudden that the fellow has gone down, or stocks are missing, or person is missing, or all that, right? Sometimes in Peta market, in almost street, messenger street, and all these kind of things happen. When you go and ask, when somebody comes and says that I want a loan, say you look at it and all that, they will say, come and see my warehouse. You put a date of inspection and then go to try to see. These guys take you to somebody else's warehouse. They set it up. You've got to be very careful. You guys set it up, and then somewhere they will go and show that this is our warehouse, because their shop will be at some place, the warehouse will be at some place. Mostly these guys are like that. They can't, at the shop place itself, they can't have the warehouse. At shop place, they will have a small stock. A warehouse will be there. So they will go and show somebody else's warehouse, and then you go and see that, oh, this much of stocks are there. Okay, fine, all right. You pass the loan and all that, and loan being settled and all that. Once the loan become delinquent, unable to pay, when you go and check it, maybe when you go to the stores, they will say, no, this is not his stores. He said somebody is coming to see that. That kind of things also happens in the market. So good to be careful. So even if the loan is being paid or whatever, this kind of probing thing has to be. This is what we say, a healthy skepticism. A healthy skepticism has to be there with the bankers on anybody, not to take what is told as it is. So he can be your good friend also. He can be a friend, and he can be, but bankers need to have that kind of a natural sense of skepticism. Always trying to cross check what is told is whether it is right or wrong, right? So that kind of alertness has to be there with the bankers. If not, bankers can be taken for a ride, right? If not, you can be branded as not a good lending officer, right? So that is important. So even if the loan is paid on time, trying to be in touch with the customer is something which a very good lending officer's quality, right? Okay. Anything else?
Ensure whether the customer contribution is brought.
Yeah. If you are giving a housing loan, and let us say 25%, 75% bank and 25% customer, and you go to inspect the place to disperse a loan. So let us say you are dispersing in three phases. Okay, up to up to foundation level so much, and then up to slab level so much, and then completion so much. Like, I mean, you know, you inspect and disperse. But let us say you go to see only the land is there, no work is not been done. Then he says that waiting for the bank loan to start the work. What you normally it should come to you is that, I mean, okay, your portion is 25%. Have you applied that? Right? Have you applied the 25% to put up the house? At least foundation partly should have been done, right? Up to foundation you should have done. Like, I mean, you know, with the 25%, how much you could have done should have been done. So you apply your capital first, right? You ensure that capital is applied, and then to say that, I mean, you know, go and see that whether loan is used for the purpose, right? That is also is important. The other thing is that you must look at the accounts and see that whether this is reflected, right? When you're doing MI, when you're doing a review, in the accounts it should be reflected. Okay, loan taken and then applied where a particular asset purchased, it should be reflected there. Asset value has gone up during this one here, it should be there, right? So bank account, bank loans have gone up, and then assets have gone up for the customer. It should be shown by that amount. So okay, so I think that's good enough for you. So that also 1, 2, 3, 4, you can mention that. So what are the important changes brought in by the Basel III? Right? Basel III. Basel III we looked at, I mean, Basel I we looked at, Basel II we looked at, Basel III we looked at. So Basel I we looked at regarding only the capital, you know, capital adequacy based on the risk-weighted capitals of the bank. You know, you have this capital adequacy that 10% core capital, 5% should be the core capital, and with the supplementary capital and everything, it should be 10%. So that's on the capital. So Basel II we looked at, you know, 3 stages of credit risk, market risk, and operational risk we looked at, right? And credit risk, market risk, operational risk. In that credit risk we looked at, and then okay, in the normal way, what you are doing under Basel I, we are doing under Basel II too. But additionally, for operational risk and market risk, how the risk, how the capital to be calculated, we calculated all the methods we looked at. So that is under Pillar 1, Basel II. Pillar 2 we looked at the, you know, the market discipline, in the sense, not the market discipline, I mean to say, we looked at the ICAP document, internal capital adequacy and assessment, what do you call it, process, internal capital adequacy and assessment process, ICAP. So under ICAP process, what happens is that you, risk department, will have to prepare a document, ICAP document, mentioning about the assumptions used in calculating the credit, operational, market risk, and then its adequacy. And then the document has to be done and given to central bank. Central bank will look at, and then they will, if it is okay, they will endorse it. If they are not okay, they will put corrections where the capital allocation is okay. They will say this has to be done. So that's the process. Then the Pillar 3, we looked at market discipline. Market discipline is that, I mean, how do you declare about your information to the customers, to the general stakeholders, shareholders? How do you give that discipline about the market discipline, what things to be declared has to be mentioned in the, has been mentioned in the pillar 3. That's about the market discipline. Then Basel 3, we looked at the capital requirements have gone up, right? Capital requirements have gone up. Currently, you see that domestic systemically important banks, the capital requirements have gone up to 14.5%. Other banks 12.5%, right? Out of that, about 7% is the core capital, and then you have other capital buffer, and then the segregation I forgot now. I need to have that. So you look at my presentation, what I gave you in that. In that I have mentioned all that under what headings you have the capital. So what are the important changes brought in by the Basel III is that code maintenance of mandatory capital by banks. You will have to go through my presentation on the Basel III. There I have told from this 10%, 5% core capital and then 5% supplementary altogether 10% capital. What are the changes which has taken place? The capital requirement has gone up to 12.5 and 14.5%. 6 domestic systemically important banks, it has gone to 14.5% capital, and other banks it is 12.5%. And the breakdown of that has been given, right? What is the breakdown of that which has been given in the purposes has been given. Please go through that. Right at the moment I don't have here to show you in this. So that is, from that you would have to answer from the Basel to Basel 3, what are the changes, why it has been changed. Those, from that information you have to provide. Okay, take a small break. We'll meet around 11:20. Right, going to be 11 o'clock, I think. We'll meet around 11:20 and then discuss the rest of the areas. I will update you on these particular changes in the Basel III also. I will take that particular presentation and I will update you on that, right? So that also I will do. And the rest of the questions, let's see, and then have a discussion. Okay. So what we were looking at on the Basel III is capital structure goes like this. You know, can you see the board? No.
Yes, sir, we can see.
Right, okay, fine. Yeah. So what happens is, you know, the common equity tier 1 capital under Basel III is 7%, right? Common equity tier 1 is 7%. And there is a capital conservation buffer 1.5%. That makes 8.5%. Common equity tier 1 capital, common equity, and capital conservation buffer, these two becomes 8.5% of your capital. And the total capital ratio for the banks is 12.5%. It's 12.5% basically for banks, but higher liquidity absorbency rate Basically, this is for the domestic systemically important banks, DSIBs. It's called DSIBs, higher liquidity absorbency rate. For DSIBs, there are about 6 banks have been identified as DSIBs, domestic systemically important banks. For them, additional 1%, 1.5% capital needed. That is to sort of meet the liquidity needs in case of any problem. That is because these banks, these domestic systemically important banks, are supposed to be very important to the economy systemically. If something happens to those banks, economy can get affected. So due to that, for them, additional 1.5% capital also needed. So that means 14% for them. So 6 banks in the market is 14%, others 12.5%. That's the capital requirement, right? So 12.5% is formed of, common equity tier 1 is 7%, capital conservation buffer is 1.5%. And the total capital should be 12.5%. So that's about your Basel III capital requirements. Right, that's about your Basel III requirements. So when we talk about what are the important changes brought in by the Basel III, is this one. This is that the capital structure has been changed to reflect, additional capital. Earlier, altogether, we had the all, all 3 risks together, whether it is credit risk or market risk, operational risk. Altogether, we were having 10% capital earlier. Currently, it has gone up to 12.5% for generally for all the banks, and then for domestic systemically important banks, it has gone to 14.5%. Right. So for domestic systemically important banks, additional 1.5% has been introduced, right, as to safeguard them. Other than that, there is a capital conservation buffer of 1.5% also has been introduced, and common equity has been increased from 5% to 7%. Right, those are the changes when it comes to Basel III in the capital requirement. And Basel III also, they introduced 2 important ratios that the bank need to maintain. The 2 ratios are liquidity coverage ratio, LCR. It is called LCR, liquidity coverage ratio, and then the other one is net stable funding ratio. 2 ratios which we looked at down the line. We looked at one is liquidity coverage ratio, LCR. That is basically to look at the 30 days. For the next 30 days, what is the outflow from the bank, and then for that you need to have liquidity availability. So for the next 30 days, what are the kind of deposits going to be withdrawn, how many loans to be disbursed, other withdrawals general from the general trend, and all that has to be calculated. And then you need to keep that 100%, you need to keep liquidity for that, right, for the next 30 days. Right? Next 30 days. So that means your calculation goes like liquidity requirement for the next 30 days, right? divided by high quality liquid assets, HQLA, you call it HQLA. So total outflow for the next 30 days divided by HQLA is equal to 100. It should be minimum 100. That is a liquidity coverage ratio. That means for the next 30 days, whatever which is going to be going out of the bank, out of your financial institution, you need to have liquid coverage for that. That's what basically means. So the history of this coming is that during 2008-9 and all that, though the bank's capitals were all right, due to liquidity problem, many banks fell into trouble. When there is problem, that's what right from the beginning we were discussing. When there is problem of liquidity, then it will be a bank run, and it will be like it will come to the point of closing the organization becoming bankrupt or unable to run. That is because liquidity is not there. I told you that there were banks, Northern Rock like banks had to be closed down for the simple reason that they had lines with the other banks for their funding. So they were borrowing from other banks. They had limits. That means to borrowing limits they had. But during a distress situation, all the other banks, freeze the limits, and then they said we can't lend. So this bank fell into trouble because they take from interbank market and then they lend. So when the liquidity is not there, they were unable to meet their depositors, their commitments, and then they had to close down. Northern Rock failed bank from UK. So one of the reasons why that this particular liquidity coverage ratio was brought in. So liquidity coverage ratio is equal to liquidity required for the next 30 days, liquidity outflow for the next 30 days divided by the HQ, high quality liquid assets, HQLA. That's what high quality liquid assets means the cash what you have. Oils, the deposits which you can immediately convert to liquidity, cash. Oils with minimum effort you can convert, right? Without any minimum effort, you can convert those assets into liquid assets. So those are the HQLA that also in your theory which is there down the line. You can look at. So the other one is that net stable funding ratio also you must have with the liquidity availability. You must plan for the next 360 days and then prepared to meet the liquidity requirements for the next 1 year. That is net stable funding. You must have stable funding arrangement for the next 1 year. Okay. We looked at liquidity coverage ratio for 30 days. Net stable funding ratio is that you must have arrangement to cover your outflows for the next 1 year. Also, that there should be arrangements. That's what net stable funding ratio says. So those are the three things under Basel III which came in. Basel III, the capital requirements have increased, right? That we looked at how the capital requirements have gone from 10% to 14.5, 14% for domestic systemically important banks, other banks 10 to 12.5%. How it increased we looked at. Then we looked at LCR and we looked at net stable funding ratio, NSFR. All right. Okay. Any questions? Okay, that's for your knowledge. Then, what are the basic safeguards to be taken? Can you all hear me?
Yes, sir.
Okay, fine. So what are the basic safeguards to be taken by a bank in participating in a syndicated loan arrangement? Now, this is a 5-mark question, right? Now, syndicated loan, as we saw, that syndicated loan is a, what happens is that when one particular lender cannot meet with the customer's requirements, there are many banks get together and finance a project. That is syndicated loan. So normally in project financing this happens. bigger project financing where one loan or one lender cannot meet with the expectation. One other thing also is there that one lender sharing that with other lenders in the market is sharing the risk also. If the project goes down, he shares the risk also, right? Rather than they getting exposed to the particular project on their own. The other one is that single borrower limit. So when the if it is a bigger loan, it will be beyond the single borrower limit for one institution to meet. So those are the reasons why somebody is going for a syndicated loan arrangement. So what are the basic safeguards to be taken by a bank in participating in a loan arrangement, syndicated loan arrangement? What happens is that when you are going in, participating in a syndicated loan arrangement, there the terms and conditions must ensure that the terms and conditions of disbursement and recovery should be same for all the lenders, right? Same for all the lenders. Now, you can't say that there will be one party who is the lead arranger, which is the bank which is arranging the loan, which is the bank which is preparing the IM information manual they prepare, and then they canvas other banks to participate, and then they prepare the agreement to be signed by the banks, and security arrangements they sign. All that is done by the particular lead arranger. So what they do, the lead arranger will have a fees, additional fees for doing all that. But when it comes to loan, it should be equal for everybody. The rate should be equal. Now, I'm giving 500 million. The rate what is given to me, and some other bank which is giving 1 billion, rate should be equal. You can't have one different rates for different banks. So that you need to ensure. That's number one. Number two is that in such an arrangement, you must ensure that the security is equally shared. The security is equally shared. That is called pari-passu security sharing. Pari-passu. Pari-passu is P-A-R-I-P-A-S-S-U. Pari-passu. Pari-passu security sharing arrangement. That means pari-passu means it's equal rights. It's not that one is for primary, the other one is secondary, not that. Can't say that somebody is primary, I am secondary. Now, like lead arranger will have the primary right. If there's a problem, he will first take, and then secondary is no. Everybody should be on the same rights. Everybody should have. That is what we call it pari-passu security sharing arrangement. That means the security, whether if a property mortgage is taken, that mortgage to everybody will be the same right. If it is, let us say, you have taken a mortgage for 5 billion rupees. Okay, so 5 banks, 1 billion each, 5 billion. For 5 billion, you have taken the mortgage. Let us say the project failed. Let us say that the property was sold for 3 billion. The property was sold for 3 billion. Based on the capital outstanding of individual banks, you need to share that amongst the banks, right? That is why you have the pari-passu security sharing arrangement, equal rights security sharing arrangement, and then in case of a loss also, it has to be on a proportionately, it has to be shared amongst the participants. So those are the safeguards you will have to take. You must ensure that security is shared, right? Security rights are shared amongst the participants with equal rights. There should not be any primary, secondary. Then the other one is what? You need to okay, the lead arranger will arrange it. You need to ensure that everybody based on the amount what is being contributed, they have the equal rights. They have the security also, access to the security also for them to recover. So everyone should have equal rights. The terms and conditions should apply to everybody at the same level. So the terms and conditions cannot be different for bank to bank, except for the fact that for extra effort of organizing, preparing, coordinating, for all that, there will be additional fees by the lead arranger. Lead arranger is the bank which is arranger. So that's about it. So briefly, you must mention about the syndicated loan arrangement. Any questions here? Any questions there? So you know about syndicated loans?
So in this syndicated arrangement,
yeah,
will the interest rate which is being enjoyed by the bank will be based on the capital amount contributed by them, or all the banks are enjoying a uniform interest rate?
Uniform interest. It has to be uniform interest. Just because somebody is, just because one bank is giving 500 million, the other bank is giving 1 billion, it doesn't mean that, I mean, the person who is giving 1 billion will have higher interest rate. No, interest rate should be same. Right? That has to be agreed. That has to be agreed. Even if the lead arranger tries to do, that's what you must ensure, that you must say no, equal interest rate that it should be. For that only we can participate.
Excuse me, sir.
Yes.
In which circumstances the deed of disclaimer to be obtained from other banks?
Deed of disclaimer to be obtained from the other banks, there can be some other rights attached to that. Any on the security related this and some other rights can be attached to that. For that, if somebody has some exclusive right, there we say that, I mean, you don't claim on that. Don't claim on that. Let us say, say there is a the lead arranger has already executed a mortgage bond on that, right? And given some security. Now, given some security, and then that particular facility, now under these circumstances, they say that that will be cancelled. That particular mortgage will be cancelled, and we are going for this arrangement and all that they are mentioning. But your lawyer says that there is a small problem there, that there is a property mortgage which is to be cancelled here now before going for this. So that bank gives all the undertaking also that will be cancelled before we execute this mortgage, common mortgage and all that. But still, for all, we say you have this deed of disclaimer on that, you will not claim on that particular thing. So anything like that where you don't want one party to get any advantage of that, if there is any issue, a legal issue, legal department mentions, your legal officer says that there has to be a disclaimer here, because there can be a possible right. Only one case I told you, there can be cases only. So like that, I mean, there is a possibility of someone can have a kind of excess of right there, which can be a problem in our recovery. You go for a deed of disclaimer from that party. Got it?
Yes, sir.
Right. Okay. Any other questions? Okay, so that's a small question. I mean, I gave more than what you require. I told you. Then how the valuation of a property is expressed by the valuer. So we looked at the valuation. As a lending officer, how will you ensure that the valuation given by the valuer is fair and acceptable? This also is a 5-mark question. So now when you are looking at the valuation, you know that, I mean, we looked at valuation will be expressed by the valuer by looking at the market, and then he will say that, I mean, this is the market value of the property, this is the for sale value of the property. So he will give that different valuation, right? So market value, for sale value. So we look at the for sale value, and then a percentage of that only we will look at for the lending proposition. And more than that, as a lending officer, you are supposed to have your own independent view also. So you also will have to visit the property and see whether what the valuer says is okay. You also can just check nearby other properties, what price it is going, like anybody who has sold, or like just make a general inquiry. Maybe in person you can make, or maybe through some other party they are also, like informally you can check and see to ensure that the valuation is right. Because the valuation sometimes, okay, it's a professional setup. We are having professional valuers to value and give and all that. But this is Sri Lanka. Things can happen. So we have, I told you, I don't know whether I told you all, we came across a situation where we were funding a developer. The developer was developing a housing scheme. So the housing scheme, for that, for the person to develop that time, buying land and putting up the housing scheme and all that, bank lent valuations were done and all that. Now, as the developer putting up the houses, the selling of those houses, also facility was given to the customers who are buying the property from that scheme. Loans were given. So you can see that there are two sides of valuation taken. One valuation taken, while you are for the project, when you are lending, and you are for the development, you are lending to the developer. Now, on the other side, there are people who are coming and buying the property. So the bank has to release that portion and give a housing loan to that particular customer, right? The person who is buying the house. So like that, these things were done. Now, what happened? There were problem. Like these guys, in their business as well as in the project and all that, they made losses and then they quit. And there was some irregularity from the side of the branch manager also. So when you went and looked at it to see valuation given, some of the value when we took and valued and to see, the valuation given by the second valuer was about half the value given by the previous valuer. He said this property is not worth that much, and it's exaggerated. So now the problem is that you lend to the development as well as then lend to the household fellows also will come in say that based on the bank's valuation only, bank appointed person's value only we have value only we have purchased, and then now that value is said to be low and all that. So that side of problems also there. On the other side, the developer also his loan recovery also becomes a problem, because you need to buy the rest of the properties also to recover the loan because overvalue. So the valuation, that's why a lending officer also need to have a judgment on that, whether that is okay. You can't just depend 100% on what the valuer says. Valuer can be, it's not a regular thing, but really there can be misjudgment by the valuer also, right? Unfortunately, if the valuer was influenced by the other party also, it may also can happen. So we need to be careful about that. There should not be any undue this one. So now we also do that. When I was a branch manager and all that, when we look at it, we bring down the loan value. We say that okay, you can go for the loan, valuation is all fine, but we only will go for this much of mortgage and this much of loan. We can't go more than that. So we restrict on a logical argument. They can't lend, right? So that is the property, the valuer will express the valuation by that way, market value, wholesale value for the bank to suggest, and then the valuer, while valuing, you will have to express the marketability, saleability of the particular asset, right of way, whether they have, whether any obstruction the property has by the person who is occupying before. Sometimes if a politician's property is in front of that, and then you need to pass that and then go to this particular property, sometimes the politician might block the road and wait, right? I mean, they are famous for doing that. They can block the road or put a kind of a canopy over that, and kind of things they can do. So, I mean, all that the value we'll have to look at with how the access to the property, where the right of way is there, all that has to look, and then they will have to give the valuation based on that. So, as a lending officer, how will you ensure the valuation is given by the value is fair and acceptable? Is that time you also need to have your independent, inspection, inquiry on the property, and then justify yourself the value given is just and fair. Right? We are not experts, but we are in the business of lending. We must have our own judgment that if there is any issue like, if it's exorbitantly high, we may have to consult another lawyer in that case, another valuer, right? I mean, in exceptional circumstances, right? So the important thing is that we can't take what the valuer gives 100% right also. We need to have a probing eye. That's what I say. You must have a what I can say, you must have a slightly, you must question that any assumption you must question whether some assumption is right. Okay. Next one is elaborate on the important steps in evaluation, approval, and disbursement of an advance. So you all are preparing loans. Your evaluation loan proposals. You are preparing proposals. So what are the important steps in evaluation you all do? Go on, tell me. What are the important steps you all go through in evaluation, in the approval process, in disbursement? What are the steps you tell me?
Repayment capacity of a customer.
Yeah. So you look at the repayment capacity of the customer, right? Okay. That the evaluation, yes, okay.
Structuring facilities accordance with the customer's business pattern.
Yes, you must first look at what the customer does. What is the you must have a calculation about what are the requirements, and then why the customer will say I want this and that and this, and then you must know exactly what is needs, right? That's what we said. I mean, you should not lend more, you should not lend less also. If you lend more also, you will abuse. If you lend less, what will happen? You can go to the market and then borrow from the money lenders, or from high cost funding, or go and get exposed to some other lender, right? That also can put strain on the cash flow to settle our loan. So due to that reason, you will have to structure the facility, evaluate. I mean, okay, according to your business, all right, this is the working capital for which you want, because these are your turnovers. These are turnover you are looking for. So the additional cash flow from the bank working capital is so much should be given, and these are the LC limit. These are the if there is any discounting bill discounting limit, if there is any ideal limit to be given. What are the term loans? What are the purpose of the term loans? So that the structuring has to be absolutely should be done. So that's very important. One of the very important points of preventing some customer from performing well, or preventing some customer from becoming non-performing is the structuring. What else?
If it is risky project, ask that customer to increase his contribution.
If it is what project?
If it is risky kind of thing,
yeah, exactly.
So ask that customer to.
Yeah. So if it is a risky project, if you foresee that there are ambiguities are high on this project, I mean, there is chances of the percentage of chance, the probability of chances that, like, I mean, where a customer might get into trouble or whatever, if it is high, you increase the equity. It's a higher contribution needed. Why higher contribution? with more contribution with the customer, the more care and attention comes from the customer, right? In case if the project fails also, the bank exposure is lesser, and the customer's contribution is high. Somehow he will try to make sure that the project works. So that is why if you go and give 100%, there are a lot of projects for which people come and ask for 100% from the bank. Not that we can't give, not that customer's credibility there is any problem or whatever, but customer his commitment will be higher with his equity. So the more the equity, the better as far as customers the particular project's riskiness is concerned, right? So yeah, equity contribution based on the risk. Then
ensure whether the loan funds is utilized for the working capital requirements or capital expenditures.
exactly, proper usage of the particular. If you are given for working capital, it should be working capital. If from working capital, one very easy identification is that if the working capital is taken and infused somewhere, your working capital will become hardcore. So working capital can become hardcore. One may be because of misuse of funds. The other may be because customers' pricing is wrong, or customers' recoveries are in trouble. Customer is not recovering. Is debt is high. If the debt is high, you will look at the age analysis. What is the age analysis? How long the customer has not recovered, right? So it has to be turned over now. So you will look at that. I mean, otherwise, if that part is okay, is recovering the debt, and I mean, according to age analysis, he doesn't have any long outstanding. I mean, beyond 90 days, credit not recovered is not there. But still, for all there is hardcore. That means money has gone somewhere else, right? So that has to be ensured. Right? Okay. So you need to structure your paper. You will have to say these are the areas you will have to say. So I mean, structural risk you spoke about. And what are the other risks you looked at?
Management risk.
Yeah, management risk you let. Yeah, management risk is something also we spoke that somebody, I mean, in the management, whether people are there properly managing their affairs, whether proper marketing, proper accountancy, proper financial, whether proper leadership, whether so the management, how the management administration of the company, management risk, right? So whether then the succession also in a previous thing we looked at, succession should be there, management should be there. Those are all areas you will look at. Then you will look at the structural risk, and then what else?
Market risk.
Yeah, you look at the market risk, the particular products, customers' products standing in the market, and then what is the market share, and how can he sustain, whether there is any threat, imminent threat in the near future, or look at, I mean, whether this product can sustain in the market, whether there will be any competitor entry, right? Whether there is a threat of this product becoming going out of the market. Right, okay, like, I mean, whether anybody else is coming in with cheaper product trying to encroach into customers area, that market risk you will look at, right? Okay, then okay, so those areas you will have to look at. I mean, your evaluation, you will have to evaluate then you look at the security risk, right? You will have to look, what is the security, what is the risk, you will have to see that what is on the security, what is the risk, right? So you will talk about the purpose for which you are doing, and then you talk about the structure, you talk about the management, you must talk about staff, security risk, and then right. So that's your evaluation, right? Elaborate on the important steps in evaluation, right? And then you put it for approval. Approval according to the approval limits set out in your lending policy, credit policy of your bank, of your financial institution, according to that. And then disbursement of a advance. And then thereafter, after completing your security documents, after taking all the security documents from the customer, whether accepting the offer of the bank, right? Customer has to accept the offer. And also, two of the important documents in the process is that customer's application is important. That's a very good. That's important. Where customer, you have given the loan, if the customer goes to courts and says that I never asked for loan, you can't recover, right? It may sound silly, but that's how the law works. You need to have the application for the customer's application. After approval, you need to have the letter of offer signed by the customer. Terms and conditions should be signed by the customer. Then the other security documents. You must have your mortgage, means mortgage has to be signed. Any security with what you are taking on that compliant document should be signed, executed properly, notarially executable means should be executed and lodged with you. So that's very important in the whole process of your disbursement or transfer for loan. Right, okay. So briefly, if you can write on those things, that's enough. Write short notes on any four of the following. On balance sheet, what do you understand by on balance sheet and off balance sheet assets? Give me examples.
Sir, excuse me, sir.
Yes.
So before that, sir, this is additional one.
Yeah.
So that syndication loan, can
Yes.
we go for that priority execution for these syndication loans?
Syndication loan, parate execution, there is no precedence, right? There is no precedence because, like, I mean, you know, project loan, going on a project loan, going for a, this one going for parate execution, there is no precedence. I mean, as far as I can see all the tested cases, but you can't say you can't go for parate execution. You can. The conditions, if you look at, see, you have, you know, property mortgages taken with equal rights for all the banks you have taken, which is more than 4 million, capital outstanding, capital plus interest outstanding, above 4 million is there. And the security is a particular kind of a company's own assets or the customer's own assets, if it is there. So when all the other conditions are satisfied, there is nothing to say that you can't, on a syndication loan, you can't go for parate execution. But due to the complications what you have compared to with an individual, probably there is no, I didn't see a precedence, but it can be done, right? The project loan as a whole failed, and then you know, we have to go for syndication. I mean, go for parate. Is I didn't come across a case, but by saying that, I don't say that you can't go for. You can. You can. The law gives room for that. So I don't think you can't. You can. Okay.
Okay, thank you, sir.
Right. All right. Okay. Then on balance sheet, off balance sheet item, what do you understand? Tell me.
On balance sheet, direct facilities, direct liabilities. Off balance sheet, contingent liabilities.
Okay. On balance sheet, funded facilities, right? Those are funded facilities that, you know, when you part with the funds only, because our financial accounts, our profit and loss account, balance sheet and all is based on actual disbursement, right? If the money is actually dealt with, it comes there, right? If the loan is given, right? If a deposit is taken, yeah, if it is invested. So you have parted with the money, or you have got the money, right? So the transaction done, fund transfer has happened. But there are many other important serious instruments are there, where money has not transferred, but it can put you into trouble. Now all these treasury transactions and all that, that's how some of the banks totally fail due to mishandling by the dealers, right? Some rogue dealers deal and then put the whole bank into trouble. And there was a dealer, a British bank, Barings Bank, which is a 200-year-old bank. In 2000, the 200-year-old bank had to be, shut down, became bankrupt because of one dealer who was operating from Singapore, rogue dealer. He went and did some derivatives. And the losses are so much, by the time they accounted for in the books, bank didn't have money to pay. So much of losses. Anyway, after that period, of course, lots of risk management measures have come, and then the third office in the treasury has come, front office, back office, and then middle office has come, and then the market risk is separately assessed, and these things are there now. After that, so much of improvements have taken place in that area, but these are waiting time bombs, like these off-balance sheet items. So we need to be careful about that. That's why the importance of off-balance sheet items. Now, let us say we have given a big guarantee on behalf of somebody. The guarantee, if it is claimed, that's huge, right? So those issues are there. The guarantees are there. The LCs and all, till the documents are submitted, those are contingent liabilities, right? Then what I can say, the guarantees, different types of guarantees, LCs. These are all things which are contingent, and then the transactions which are entered, future transactions entered by the Treasury Department, right? All these are contingent items. So on-balance sheet items are funded facilities, funded items, like even deposits and liabilities, so assets or whatever. Okay, so you will comment on that. So what is the difference between equities and debentures? What is equity? What is debenture? These are 10th standard question anyway. Just tell me. Equity is a equity capital, right? Debenture is a loan capital. So equities and debentures, if you are asked to write, you may have to write the qualities of equity, qualities of debentures. Equity is a equity participation in a company, and then equity holders get a dividend, right? So dividend is paid at the discretion of the company. Debenture holders they provide loan capital to the company, so that they are paid an interest. So whether the company makes a profit or loss, debenture interest has to be paid. So on those lines, we will have to write about equities and debentures. Those are simple things. So venture capital companies, we have spoken a lot, right? Venture capital companies, we have spoken a lot. And we also looked at that in the market, the venture capital operation is the one which Sri Lankan market also needs for people to, to really see that from the early stages, companies grow into bigger commercially viable projects, right? So for that, normally the appetite of commercial banks in the market, the appetite is not there. So that kind of a we also call in a smaller way, it is angel financing, call it angel financing, venture capital companies. So that kind of people are less in the market. There are only very few venture capital companies, and bigger ventures, like where you don't have proper, kind of a financials, it's a new venture, so investment is there for that. These companies will go and assess the project, and then take equity participation, and then sit in their board or sit in the management, allow it, structure the business, and then advise the customer, advise the investor, and handle the investor till he becomes successful in the business. So they take equity partnership in that business, and then after a period of time, when the business becomes viable, they will find a they'll find an exit route and go. Exit route may be by way of floating an IPO, initial public offering, and then selling the shares in the market, or selling the shares to somebody else, right? Or else holding part of it and part selling. Like that, they will exit. So this is quite different from the banks, right? So that is something which is important for a growing economy, where you need to have angel financing and then venture capitalists in the market. Right. Then the role of credit rating agencies in risk weighting the assets. Right. This you looked at the early stages, what we studied there, the company's credit rating. Now, according to central bank, the companies who are borrowing are supposed to credit rated too. So the credit rater agencies are there, ECIAI they call it, credit evaluation agencies. Those are approved by the central bank. From them, the companies can take credit rating. Based on the credit rating, banks can structure their price, right? That's why we call risk-adjusted return on capital. Like, I mean, you structure your loans based on the risk rating of the customer, right? Based on the risk rating. It's a good structure if that could be done, but then in the market you find not generally, people haven't taken the credit rating report. So if that report is there, for example, let us say John Kills, they got a AAA rating. A AAA rating means then they will ask for the prime lending rate and all that kind of thing. So they say we are a top-rated company. Yes, that's justified because they are top-rated, big conglomerate. Credit risk is less. So based on the risk levels, you give a better rating, lending rate. So the credit rating agencies help the banks to properly risk weight the assets, right? Why? With their help, when the customers are risk rating, based on the risk rating, we will be able to risk weight as per the Basel guidelines, right? Basel guidelines are there. Based on that, we will do the risk rating, and then capital adequacy we will do according to that. Okay, those capital adequacy, how it is calculated, and all that we have looked at. Okay. Now tell me, what is a condition? What is a covenant? What is a condition? What is a covenant? So you are executing, dispersing loans and all that. You are talking about that's a covenant. This is a condition and all that. What is a condition? What is a covenant?
Condition is something that should fulfill, and covenant is something that being imposed, restricting the customer behavior from something being done.
Exactly. Condition is a prerequisite, right? Condition is a prerequisite. It has to be there to do something. Now you say, subject to this condition, your approval authority will say, subject to this condition, loan is approved. So they will say, subject to taking mortgage for the full amount of the loan, this one, right, for this amount. Or else they'll say subject to having a savings build up every month. The customer deposits an amount of 100,000 into a savings account to be kept as a security to the bank. Subject to that, this is approved. So, like, I mean, there's condition. I mean, it has to be, there it has to be fulfilled. So the covenant is that you put a clause, the loan clause that controls the behavior of the customer down the line, right? The customer, you say that you have to, let us say you have to lend only to this sector. So covenant is something that, I mean, the loan is given. Let us say you have taken a multilateral funding agency like IFC or somewhere, or ADB is giving a loan, telling you that this loan is given with the covenant is there that you can only lend it to SME sector. Now, if you lend it to any other sector, if the fund is used for anything else, you are liable to pay a penalty. And when they do the review, if they identify down the line that a small part of the loan given has been dispersed to corporate sector, not to the SME. So it's a violation of the covenant, and they can impose a penalty on us and say, okay, you have violated the covenant, right? So that's the condition in covenant. Condition is a pre-existing thing. I mean, precondition. Like, I mean, there's subject to that. Subject to this only, you do something. A covenant is something which is controlling the behavior, as you rightly said, controlling the behavior of the customer down the line, and you have to comply with covenants. All right. Asset liability committee, we have spoken. We have elaborately given a presentation also on that. Go through that, and it's an important committee as far as a bank is concerned. The lending and funding activities of a bank, right? So through the asset liability committee only, it is decided now how much of fund available, how much of deposit we must additionally take, how much of lending we'll have to do, what are the new products which are to be taken into account, like how is the lending gaps, deposit gaps for the next 1 week, 1 month, 3 months, 6 months, 1 year. Those gap analysis is done, asset liability. So asset and liability properly mature. So most of the time what happens is that we take short-term deposits and then lend long-term loans. Now, of course, the long-term loans are going up to 10, even commercial loans are going up to 10 years and more also. So, but our deposits are all 1 year, 2 year kind of a deposits. So that's mismatches. So how are you going to manage it? All that is spoken about. Whether capital you are maintaining the capital properly, right? Whether risks are, whether any compliance risk is there, right? So all these things are handled in the asset liability committee. Interest rates are decided by the asset liability committee. Lending rates are decided. Product deposit rates are decided. Whether to continue with a product is decided. Whether a new product has to be introduced has to be decided, right? Particularly whether the cost and all that. So that's a very important committee of a bank, and you need to write on that. Okay, can you come on the side of
next week commercial lending and project finance start करना है.
Okay, yeah. Next week for you all, commercial lending and project financing will start, right? Keep in mind, hope at the same time, commercial lending and project finance, right? Okay. Then look at what are the adverse effects of financial institution when it cost of funding. This is many a time happens in the market when the institution resorts to high cost borrowing, when they go for desperate measures, low cost funding they can't get, they go for high cost borrowing. When they go for high cost borrowing, they can't lend it to the regular customers, because customers will ask for lower rate. So you will have to go and lend it to people who are getting loans at a higher rate, and they are high risk. And the high risk customers can put the, they can default. When they default, your NPA will go up. When the NPA goes up, your profitability goes down, right? The profitability goes down, NPA goes up, then again you are getting into the vicious circle, right? You can't raise funds, deposit. So it will be a bad sign. People will start taking the deposits out, thinking that this is risky. This organization is getting into risky areas. Bad publicity. Overall it will be bad for the organization, right? So it will start with a small thing, but it has a very telling, very significant effect on the financial institution if this culture is changed, right? Okay, we are going and taking the so it's the same thing for a business also. When they go and take high cost borrowing for a short term thing, and then they really get into that particular cycle, and then many a times I have seen businesses fail because they can't sustain that. Right? So what is agency theory? We looked at agency theory in lending. Basically, is that you're giving the management, and then down the line, everybody act as agent of the board. Board gives a delegated authority, and that is given to the managing director or CEO. CEO gives a delegated authority down the line for people to carry out the lending representing the board. So that is the agency theory. Why should banks have a hierarchical approval system? Because that's a 4-eyed principle, right? Different limits at different levels are given, right? That is because there has to be proper checks and controls so that you avoid one person or two person taking a decision, because as the amount is high, the number of people involved in the approval process also is high. If it goes up to the board, you will start from the manager signing, regional manager signing, somebody in the AGM signing, and then DGM signing, and then executive credit committee, board credit committee, and then board. So many people. So what happens is that it getting filtered. So if anybody has anything to say that we should not do that, it can be stopped at that level. People. So that is the hierarchical approval system basically gives a comfort to the organization to sort of limit the non-performing advances. Non-performing advances can be limited by this 4-eyed principle. Instead of 2 eyes, 4 people, 4-eyed, two more people looking at it. So that's about your paper. We have looked at 2 papers. We have covered our syllabus, and you all have done the assignment, and only thing left is you all to write the exam. So exam format also we have discussed. So you can be ready until the institute tells you when the exam is going to be. There are some issues, I think, conducting in-person exam. Some health authority concerns need to be looked at, and then approval to be obtained. The moment the date is fixed, you will be informed, right? Okay, so I really enjoyed taking up this session and spending time with you. You are intelligent students. You can do well. So hope that you all will do well in this course as well as in your career, in your life. Do the simple things right. That's all I can say. That takes you a long way. So whatever you do, you try to do a perfect job. Whether it is the same thing, whether it is at home or whether it is in office or whether it is in your studies or whatever, that takes you a long way. So wish you all the very best in your course, and in your personal life too. Wish you all the very best. Hope you all will complete the exams and then complete the course successfully, and then hope that contributes to your career advancement and enrichment of your CVs. So anytime you have my email address, do write to me. If you do not have, you can make a note of it. sprabag@gmail.com. sprabag. Yes, Prabhag. sprabag@gmail.com. You can write to me, and I'll get back to you with the answer. So that's it from me, students. Any questions? Any questions? Are you all okay? Are you all comfortable?
Yes, sir.
Yes, sir.
Right. So that's great. So wish you all the best until we meet next time. Let's see. I really missed the opportunity of seeing you all in person and then doing the class. That is something I really enjoy. Anyway, hope the situation improves. So wish you all the very best. Okay.
Thank you.
Thank you very much, sir.
Okay.
Yes,
Bye.
sir.
Thank you, sir.
All right. Bye.
Thank you, sir.
Okay.
Thank
Bye.
you very much.
Okay. Welcome.